Very nice to see you again. Thanks for your comments after the last video. Always appreciated. Please keep them coming. And if you haven't, please subscribe to these videos so that each time I release either a short version like this one or one of our longer versions where we talk with one of the money managers that we work with regularly, then you'll automatically receive notice that there is a new video. Just going to take a few minutes to speak about something that is going to become more and more front and center. So getting the spotlight over the course of the next, let's say 90 days will be the debt ceiling. We have seen this movie before. It is not pretty. The rhetoric that comes along with it is quite strong, can be quite frightening, frankly, when looking at headlines, listening to reports, picking sides, if you will, as it applies to the debt ceiling, whose fault it is. Well, like I said, we have been through this before. Let's go back to 2011 in the debt ceiling crisis at that point, which was fairly new in we'll say, delivery of news to all of us. And I still say was far more frightening because it was this now known thing that we're dealing with, unknown in 2011. My friends from Morningstar have provided a really nice chart for you to look at if you'd like to, and I'm going to include that at the bottom of this video on YouTube. You can click that link and read a little bit more about that. I promise no charts or graphs on here. But point being, from their information, there is going to be a lot of posturing. There is going to, all that posturing is going to create a lot of volatility in the stock market. It will create volatility in the bond market as well. Now, volatility is generally connected with negative. Well, it can be volatility on the upside as well, meaning the possibility of gains in certain areas of not only the stock market, but in the bond market. It still remains volatile because is that a permanent kind of increase in value or decrease in value if you're on the other side of that? So Morningstar providing some great information there, 2011 debt ceiling as part of the history of this. Move forward just a few years, 2013, what a lot of us may not recall about 2013 that was so unique with the debt ceiling fight is that Standard & Poor's, a bond rating service, downgraded U.S. debt in 2013. You would have thought, wow, all of the treasuries, everything else would sink in value. Well, instead, on a short-term basis, they increased in value rather immediately. And then as the debt ceiling crisis came to a close and a deal was struck in the 11th hour, well, suddenly the increase that had been there for bonds during that debt ceiling crisis disappeared. So what does that mean? What am I getting at by sending out this debt ceiling video? Expect a lot of rhetoric around this. Expect posturing on both sides that a deal will not be closed because of the other side. Expect volatility within markets. Expect volatility in markets that you wouldn't normally expect, like bonds. I'm not giving any solution right now. What I am giving is the advice that what to expect, and how I am viewing this and talking with the investment firms about it is volatility. It's not always a bad thing. We are constantly reviewing investments. I am having many conversations, both directly with the investment firms, along with just by email, catching up with them, questions, answers, going back and forth. It's really helpful. So, as always, I am glad to talk about it with you directly. You're welcome to click the link, book a 20-minute phone call. We can have a greater discussion about it. However, I would say calm will prevail, and that's just how I am going to approach this latest debt ceiling argument, crisis, discussion, with calm, with process, and again, sticking with what we believe in, which is a steady approach to this work that we do together. Have a great day. I look forward to speaking with you soon. And again, if you'd like to click that link and book a call, I look forward to it.